All right, let's talk about one of the most fundamental yet powerful tools in a trader's arsenal, volume analysis. Seriously, if you're not looking at volume, you're only getting half the story. It's kind of like learning the market's secret language. It lets you in on what's really going on behind the price moves. So let's get right into it.
Oh, you know that feeling, right? A stock looks like it's taking off to the moon, you jump on board, and then bam, it slams right back down, and you're left wondering what on earth just happened. It is the worst feeling. But what if I told you there's a clue, a really big one, that can help you spot these traps before they spring? Well, that's what this is all about.
So let's talk about that secret language. See, the key is you have to stop staring only at the price. You have to learn to listen. And the way the market speaks, the language it uses is volume. Okay, if you remember just one single thing from this whole explainer, make it this. Price is just the headline, right? Stock goes up. But volume? Volume is the conviction. It's the story behind the headline. A price move on low volume, that's a tiny whisper nobody's really paying attention to. But a price move on huge volume, that is the market shouting from the rooftops.
And all of this, really, it all boils down to one simple central principle. It's what I like to call the golden rule of volume.
That's it. That's the whole game. Sounds simple, but it is so powerful. You need to burn this into your brain. If the price is doing one thing, but the volume is telling a different story, you have to get skeptical. This one idea is what separates a real, sustainable trend from just random noise on a chart.
So what does this confirmation actually look like? Well, think about it. If a stock is soaring higher and the volume is also getting bigger and bigger, it means more and more people are piling in. There's real belief. But if the price is just kind of drifting higher on volume that's drying up, well, that's like a party where everyone is starting to leave. It's weak, it's losing steam, and it's a huge warning sign.
All right, so let's put this into practice. How do we use this golden rule to actually decode what the market trends are telling us? This is where the rubber really meets the road. Every healthy trend has a certain rhythm, a kind of heartbeat, and you can see it in the volume. For a strong uptrend, the up days are loud and full of energy, lots of volume. But the pullback days, they're quiet, like the market is just taking a quick breath. For a downtrend, it's the exact opposite. The scary down days are filled with panic and huge volume, while any little bounce is weak, anemic, and happens on almost no volume at all. Okay, check this out. A perfect example. First, you get this big push-up. Price is up 2.5%, but look at the volume. It's 150% of normal. The market is excited. Then you get a little dip. But here's the key. The volume just evaporates, down to 80% of average. Nobody's really selling. And then, bam, the next move up happens on an even bigger surge of volume. That right there, that's the signature of a beautiful, healthy uptrend. Now let's look at the dark side of this. A confirmed downtrend. It starts with an ugly drop, and the volume is just massive, 200% of average. That's the big institutions heading for the exits. Then you get this tiny, hopeful little bounce. But look at the volume. It's pathetic. Only 60% of average. Nobody is buying into this bounce. And sure enough, the floor gives out again on another wave of heavy selling. That pattern is a giant red flag telling you to get out of the way. And here's a super important warning sign. It's called divergence. You have to watch out for this. So imagine a stock makes a new high, pushes to a new peak. You'd think volume would be massive, right? But what if it's not? What if the volume on this new high is actually weaker than the last one? It's like a car trying to accelerate up a hill, but the engine is sputtering. It's running on fumes. That's a classic sign a trend is exhausted. Okay, time for the main event, the move every trader loves, the breakout. This is where big money can be made, but it's also where a lot of people get trapped. And volume is the key to telling which one it's going to be. Here's the deal. A breakout without volume is a trap, period. It's a fake out just waiting to happen. So a real breakout has a checklist. First, on the day it breaks through, volume has to explode. I mean, 150, 200, 300% of its normal volume. But, and this is so critical, it can't just be a one-day party. You need to see that high volume stick around for the next 2 or 3 days. That's your proof that this move is for real. And here is what it looks like in the wild. Just a textbook case. Day 1, the price smashes through that resistance level, and look at the volume bar. It's gigantic, 280% of average. Okay, check 1. Now day 2, the price keeps going and the volume is still super high. Check 2. And day 3, still strong. That right there is a high probability volume confirmed breakout. That's the one you're looking for. So how do you avoid the traps? By looking for these red flags. The price just barely pokes its head above resistance, but the volume is just meh, average at best. That's warning sign number 1. Then, the very next day, the volume completely vanishes and the price just slumps right back down. That is a classic fake-out, a bull trap. And now you know exactly how to spot it.
Okay, so you've got the core principles. You've seen the examples. Now let's just quickly cover the common mistakes that trip everybody up at first. This is how you can skip that painful learning curve and go straight from novice to navigator.
Mistake number 1 is looking at the raw volume number and thinking it means something. 1 million shares traded means absolutely nothing by itself. For a tiny company, that might be a record-breaking day. For a giant like Reliance, it's just a few minutes of trading. It's all relative. You always have to compare today's volume to its recent average. That's what tells you if it's significant.
All right, mistake number 2, and this one is huge. Trying to analyze volume in a vacuum. Don't do it. Think of it this way. Price is Batman, volume is Robin. Price is the hero of the story, volume is the trusty sidekick that confirms what the hero is doing. A big volume spike that happens in the middle of nowhere means nothing. It has to confirm a price move at a key level. Remember the golden rule. Number 3, getting faked out by one-day wonders. A single day of high volume can be a fluke. It could be a news story, a big block trade, anything. It can be misleading. What you are looking for is a sustained pattern. You want to see that high volume for 2, 3, maybe more days. That's when you know it's a real shift in sentiment, not just noise.
And the last big mistake, trading your stock in a bubble, ignoring the rest of the market. Trying to swim upstream is really hard, right? If your stock is trying to break out on huge volume but the entire market is in a nosedive, that is a low probability bet. You always have to ask, is the overall market tide with me or is it against me? Context is everything.
So let's wrap it all up. Here's your simple checklist. 1. Always compare volume to its 20-day average. 2. Look for a pattern over a few days, not just a one-day spike. 3. Context is king. And 4, maybe the most important, be patient. Wait for the volume to show up and prove the move is real before you jump in. And that's really what it's all about. When you start understanding volume, you stop being a passenger who's just getting thrown around by price swings. You start to understand the why. You can hear the story the market is telling. You've learned the first few words of its secret language. The only question left is, are you ready to start listening?